Hello everyone, great to be with you again. Brad Macbeth here from The Simple Plan. This is The Simple Plan Live, and we're coming to you again in the middle of spring. And we are going to continue on in our series talking about security, guarantees, tax freedom, all that good stuff. So I think you're going to like what you hear today. We're going to look at some specific examples of what that might look like. And so I want to thank our continuing sponsor, the Simple Plan community. We are going to be talking about this stuff in there. So if you want to know more, have a fellow travelers to walk with, sort this out in your own life, figure out how this can apply to you, then come and join us there. Bring your questions. We all support one another in there. And yeah, it's simple. Just join facebook.com/groups/Simple Plan Community. And so I'm just going to get right down to it for the day. Take a look at things here. So this is a simple tool we have. It really just kind of paints broad strokes. So I think this will help to illustrate at a simple level how this works, because how it exactly works is unique to each family. So when we build these types of systems and plans, they are specific to your family situation and needs, and there are just many, many ways we can configure these plans. So this, rather than getting down into the nitty-gritty details of some really fine numbers and masses of them, this just gives us a quick overview of what you'd be looking at. So we're going to take a 35-year-old male in this case, non-smoker, and we're going to consider a family that has a family income in Canada here of about $120,000. And our general recommendation, of course, we tailor these plans to your unique situation, but our general recommendation as a baseline is that you be taking about 15% of your income and applying it to financial security and financial plans. So financial security means being sure that your family's taken care of financially, no matter what happens. And financial plans are building for the future, of course, those things like retirement, but also major purchases, maybe helping kids out with education if you're at that stage of life. So in this case, how do we figure out how much we're going to put into this portion of the plan? Because if you'll remember, we talked last week that this plan is really just a portion of a comprehensive plan, but it is a foundation. This is a very powerful foundation of that plan. And you would have, in addition to this plan, some investments going on that are going to build for retirement as well. We advocate for taking the cash that's accruing in this plan because it's a conservative approach with many guarantees, and using that to provide balance in your portfolio. Because in balanced portfolios, what we've been seeing over the last 20 years is the stuff that's supposed to provide the balance, which is normally bonds and some forms of cash type investments, have not been performing well at all. And so we're saying, well, look, let's keep on the balanced approach, but let's put our bond type, conservative type, and cash type investments into a place that is conservative and has cash that's guaranteed, but is actually providing a much better return than those traditional forms. And then just keep your equity investing going through mutual funds or what have you in the other portion of your plan. So in this case, we're only going to allocate a portion. So at this age, we're going to say maybe about a third. So if you've got $120,000 income, we've got 15% of that, which is $18,000 per year. And that's $1,500 a month. And we're going to take a third of that, of $1,500 a month. So we're going to take $500 a month and put it into this plan. And now remember, this plan is also going to have to provide us our broad insurance protection. So we're going to take out about, because of the age of these people, we're going to take out about $125 a month of that. That's going to go to term insurance. And so that means we're left with $375. to apply into this aspect of the plan. So we'll put that there in our monthly payment amount, $375. Now, there's a number of things we could do with this plan. We could use it to fund some various aspects of life. So let's see what that might look like. Let's say that we want to do some education funding in here. Now, if our children are young, let's see our person is 35 years old starting out here, and it's another 15 years until, that's probably too long. Let's say that 27, 40. So let's call it another 12 years until they have a child that is heading off to university. And then 35 years old, major life event. Let's say at age 60, they actually want to buy a business. All right. And so we'll put that, again, age at time of event, 60. Oh, we didn't change this one. This one should have changed to 47. There we go. And then finally, retirement. We're going to default with age 65 there. And then we're going to look at estate, how the estate can transfer at age 100. Now, I want you to remember today that what we're focusing on is financial security. So we're only going to look briefly at some of these numbers, but others we're going to look at in a little more detail. All right, so we're going to hit the calculate button here. That's fine. Okay, so we have the potential cash value at age 100 of $1,045,000. So part of that is guaranteed, and part of it is going to come from the growth in the plan. But here's the thing. At age 100, if that is what they had accumulated, that is going to pay out fully non-taxable. So from these deposits, money is going to accrue and grow, and when it pays out as a benefit to the on the death of the plan holder, it's going to pay tax-free. So let's have a look at some of those life goals as well. And we're going to look at a little more detail at this stuff next week and how you can configure things to kind of go the way you want them to for cash flows. But so in this case, they're going to have, actually, you know what? I think let me check our configuration. Yes. So we're also going to make our payments to age 100, not just for 20 years. All right, so I misspoke on that. We're going to have 1.5 million as the benefit that's paid out to your heirs or your favorite causes, tax-free. And that money, by the way, bypasses the estate process, so it doesn't go through probate fees. So you're not paying tax, you're not paying any probate and estate fees. And because it bypasses the estate process, it goes to exactly who you've named, and it is going to be paid out within a few weeks of your death, 2 to 3 weeks, as opposed to anything that goes through your estate and your will. That can take certainly several months and sometimes drags on for more than a year. Okay, so going back to that. So we have cash value, in this case, of about $27,000 available to help fund education when the first child hits college in 12 years. Again, we can access that money tax-free. Now, there are ways of accessing it where we would just withdraw it and we would pay tax. But there are other ways of accessing it where we're not going to pay any tax on that. Next, we have this major life event. We want to buy a business at age 60. Something to give us a nice extra stream of revenue in our retirement years, gives us 5 years to build it up. Then we can either sell it or we can just keep it as a stream of revenue. So in this case, there's a potential cash value to be accessed of $193,000. And again, that money has been growing tax-free inside the plan because all the money we deposit inside this plan for growth grows tax-free, and we're able to access this money tax-free. Another interesting thing is if we access it tax-free, we're going to take a loan against the asset value inside the plan. there's going to be some interest charges. Now, of course, if we're borrowing to invest in a business, we're going to be able to charge the interest against that business. So it's deductible. All right, next, we've got the retirement. So we have a potential cash value at that stage of $275,000 that we can access. So if we're accessing that $275,000, we can turn it again into a stream of income for retirement. And I would estimate, based on that, that we're going to be able to take about $800-900 a month in, again, untaxed income. So you've built yourself somewhat of a personal pension here. And again, there's a number of ways we could do it. We could actually take the entire cash value and turn this into an annuity. Now, if we do that, of course, we're going to reduce the value to our estate in the long run. And there is going to be some tax that gets paid on that. And it's a lower rate of tax, but that would be taxable. However, if we continue our strategy of accessing the cash value by lending the money to ourselves, then we are going to avoid paying any taxes. And what happens with these loans is at the end, when we pass on, the value in the plan itself, this cash value at age 100, or in this case would be the age of our death, is going to pay out all those loans and the interest and still provide a benefit to our heirs. And so in this case, we would have, again, maybe $800 a month in revenue that we could live off of in our retirement. So one of the things that we're doing here is we're trying to build layers of income during retirement. It's one of the areas people really don't think about when they're looking at their retirement planning. Everybody just kind of focuses on the accumulation, and they don't consider the tax implications of how the income is going to come out, or the longevity risk of their income. So for example, we have some forms of income that pay for life. For every Canadian, almost every Canadian, there's old age security, which for most Canadians is a little over $600 a month. We have Canada Pension Plan for many Canadians, which averages about $750 a month, but ranges from very low to up to $1,200 plus a month. And now we would be adding another stream of revenue here. We would be adding one, the two I just spoke about are taxable. We would be adding one that's not taxable. And so what you want to do when you're building for retirement is you want to build in that you have streams of income coming in from your various sources, that some of which are, at least enough of those are guaranteed so that you are going to have the ability to meet your ongoing monthly expenses through retirement without any concern about that. This is one of the most important guarantees we need in our financial planning. And others will say, well, I could get this, that, and the other. It's like, well, yes, you might if you stuck with straight equities, for example. But we're 6 months into a serious bear market right now. We're staring down rampant inflation that we haven't seen in 30 years, energy costs that are through the roof, a war with significant global geopolitical implications that we don't know how things are going to end up. And so, of course, and you almost forget, and by the way, a global pandemic. So we've got all this going on that provides all this uncertainty. If you think about that in retirement, is that really the circumstances in which you want to be trying to juggle medium risk to high risk decisions about investing? And the answer is, well, maybe for some of our money, but we at least want to protect the ability to keep the roof over our head, put the food on the table, keep the car going, that kind of thing through retirement without having to worry about it. I don't know if you've noticed, but I've certainly noticed a lot of older folks, some of whom are in very difficult shape, working demanding jobs right now, and not high-paying demanding jobs, presumably because they need to in order to make ends meet. And that demographic is increasing as the broad swath of the baby boom moves through past retirement into old age. We're going to see more and more of that. And so when we plan for this, we want to plan so that that for sure is not going to happen. And in fact, Canadians know that. They say that their number one concern about retirement planning is, will I run out of money in retirement? And there are multiple risks to retirement income. Obviously, market volatility is, and we have what's called sequence of returns risk, which means, simply put, it has to do with what the market is doing when we are first, in our early retirement years, drawing our income out of our assets. Because if we're doing that in a significant down market, then it really hinders and impairs our ability to make the money last. And then, of course, longevity risk. We don't know how long we're going to live. These plans would be perfectly simple to make if we knew how long we were going to live, but we have no idea. And so we have to plan accordingly because we have no idea. So we need that guaranteed lifetime stream of income. All right, so finally, and we're going to dig deeper into that next week and how you can really build that and how it fits into kind of an overall long-term plan for retirement. So finally now, we look at the potential cash value of our legacy. I won't call it our estate. It doesn't go through the will and probate process, but it comes out at the same time. So let's look at the details of that. So what we have here, we have two layers. One is the guaranteed layer, which is this of the death benefit, which is this dark green. And so in this case, we're looking, 200, well, let's see what this is at the beginning. $268,000. So that's our approximate starting point for our death benefit. That's our guaranteed amount. And we're going to have an amount continue to grow in this plan all the way through. Let's slide over here. And as we get to, let's look at about life expectancy. So we'll call that about age 86. So we're right on, in fact, let's go to age 87 because I think, yeah. At age 87, we've just crossed the $1 million mark, we can see here. So this individual would have accumulated $1 million inside this plan that's now going to pay out tax-free to our heirs, our favorite causes, our church, our charities, whatever it is that we really care about. And there will not be any tax paid on that. If it were a couple, because we could set this up as a joint last to die, so it paid out when the second person died. Well, with two people, the life expectancy, not the median life expectancy, but there's about a 25% chance that one of the people will survive to age 94. Well, now it's grown to $1.26 million. And if we follow all the way through to age 100, just get over to the last bit here. Now we're at that $1.5 million. Now, if we've been drawing money down, you remember we took money for that business. We probably paid it back, but we didn't have to. Or if we've been living with a retirement income off this plan, then out of that $1.5 million, the loan that we lived on is going to get paid off. Now, if we maximize what that loan could be, well, then our payout might only be a few $100,000 remaining in the plan. And again, we'll look at that in greater detail next week. But this gives you an idea of what we're talking about when we're talking about guarantees and security. So all the way through, we've had this $268,000 in guaranteed insurance that pays out. Now, bear in mind, in the earlier, remember I mentioned we're only taking a portion of that money because of our budgeted money to manage this, because in our earlier years, when we've got young children in the home and what have you, we're going to have some term insurance to supplement as well, because we only need that term insurance for a term, for a temporary need. So what we're looking at here really is the difference between renting and owning. We're going to rent what we don't need to have for a long period of time. So that term insurance, maybe we're going to have kids under our roof, finishing up college or whatever for the next 15 years, maybe 20 years. Well, fine, we'll buy some term 20 for that big liability to make sure that all our kids, as they're growing up, are cared for if something tragic happens. But once we get past that stage, we don't need that much life insurance coverage. And so we're going to buy the amount of life insurance coverage rather than rent. We're going to own the amount of life insurance coverage that's going to do two things. One, it's going to provide us with some end of life expense money, so for funerals, for legal fees, probate, all that kind of stuff. Maybe there's some tax implications there too, depending on the types of assets you have, like if you've got a family cottage or what have you. But we're also going to size that permanent policy so that we can generate the maximum amount of tax-free benefit while we're still alive. This ability to take the money out to buy the business, this ability to live off the income in retirement tax-free. So we need to create a container that we can do that in, and it's the permanent life insurance that does that. So we buy the minimum amount of permanent life insurance in order to build this large container that we can use to fund these benefits of protection and also of security and of tax-free sources of income. So what I want to encourage you today, if you're interested, if you like the sounds of this, I'm sure you still don't quite get how it all works, and that's fine. It's much easier to understand how it would all work in your own personal context. And so for those that watch us, for those that subscribe to our newsletters and such, we're offering the ability to get your own draft plan and see what that might look like for your family. And you can do that by going to go.getthesimpleplan.com/hybrid. You'll remember, we talk about this is a hybrid plan. It's hybrid because it's made up of a combination of some life insurance, some great guarantees, and some tax advantages, some tax-free sources of income, and also conventional investing. Now, if you've already got someone you're working on the conventional investing with, that's fine. You can stay there, and we can just build you the core plan to put to that strong foundation to build that lifetime of financial security on. So if you would like to see how that works and get into some more details, there's two things for you to do. You go to go.getthesimpleplan.com/hybrid. You're going to see this page. The first thing you need to do is watch the video. There's about a 20-minute video there that explains in greater detail how this works, how it happens. And then, if you're interested in knowing more, you can click to see if you qualify, because everyone has to qualify for these programs. It's not just like buying a mutual fund where you just lay your money down. You have to qualify. There's a number of parameters for qualifying, which include your health and your desire and ability to make a financial plan. So go to go.getthesimpleplan.com/hybrid, watch the video, and then click on, if you're interested, past that. So maybe you watch the video, maybe you're like, it's not really for me. That's fine too. But if you watch the video and you want to know more, click on the Apply Now to see if you qualify. Submit your information. You'll have the ability to set up an appointment, and we'll sit down with you for about 45 minutes and go over your specific interests and needs and look at whether this is the right type of approach for you and exactly and specifically what that might look like for your family. So again, go.getthesimpleplan.com/hybrid. So I want to thank you for joining us today. We're having a great time putting this whole new plan together. Really, it's been very exciting. It's generating a lot of interest. We're still continuing to refine it. This type of plan is built very specifically for your individual family's specific circumstances and needs. So it is truly customized to you. I want to thank our sponsor again, the Simple Plan community. Come on, join with us in there. Facebook.com/groups/Simple Plan community. It's free. Come on and join us. We do lots of great stuff in there. And yeah, so I look forward to seeing some of you, hopefully taking advantage of that opportunity to see how that might look and work for your family. We think that this is the best possible program for Canadian families, and especially now with all the uncertainty that we're going through. So thanks again. We'll see you again next week when we're going to dig in deeper into what the retirement sources of tax-free income can look like and how you can make the most of that for your family. Thanks again. We'll see you again soon.